I have to wonder, just given what we've seen in this bond rally, how much more can yields head lower, you think, Mark?
Oh, I think they can go quite a bit lower, judging by what the futures market is telling us. And if you look at the most recent data coming out of the U.S., the economy is softening. We had the jobs report for March, which was significantly below expectations, and then jobs report was for February, ADP payrolls for March overnight, and the ISM services PMI. They're all basically converging on the same page, which is an economy that's softening. And I think if you just combine that with what's happened in the banking sector, there is good reason for the Fed to be pausing here and eventually start cutting in the second half of the year, which would mean yields go down.
Okay, well, is that, and what if inflation continues to be elevated? I mean, we certainly have seen central banks this week saying that even if there's a pause, it doesn't really quite mean that they're going to be cutting anytime soon.
That would be a problem. Thankfully, we don't think inflation will remain elevated. We don't think it's going back to 1 or 2%, but we think it can settle between 3 to 4%. Starting in the second half of this year. And I don't want people to be bored ad nauseum hearing about the delayed effect between the real market for property prices and how it figures in the inflation baskets, but that delayed effect does exist. So we're looking at shelter numbers from last summer, and we know that after last summer, property prices peaked and came down, so it's inevitable that will be helpful, as will gasoline prices. They're way below where they were after Russia invaded Ukraine last year. So, I mean, you're right, inflation is something to bear in mind, but we think it is coming down. We're quite certain about that.
Okay, so what's the investment prognosis and prescription, Mark? Because if someone told me stock markets at various points this year, I would have gotten burned. So where do they put that money?
Exactly, David. If you'd told me at the beginning of this year we were going to have 2 bank failures in the U.S. and Credit Suisse bought by UBS under emergency legislation and all of that stuff, I wouldn't have been buying big cap technology, but that's exactly what's outperformed. I do think we're in a bad news is good news environment, and that'll probably persist until around May or June. Because people will like the fact that yields are falling. But eventually, when you get so much bad news, it just kind of turns into bad news, period. And then I think what really continues to do well is the bond market, and treasuries are already up 5% so far this year. But that's that's a place, to come back to what I said earlier. If yields are going to continue to decline, that is also a good place to be. So maybe I just say one last thing, which is I think the breakout in gold is very important and indicative of people wanting to hedge against the dollar going down. And if the dollar does soften, and we're looking for 1.15 euro dollar 12 months from now, 123 dollar yen, that's a positive tailwind for financial assets generally.
What about China, generally speaking?
Well, I like China a lot. It's reopening. And you'll have seen the housing data. The key property developer sales are up 30% year on year. And the PMIs are very robust, certainly higher than most of the rest of the world. And the market is not expensive. The last I looked, the Hang Seng was sort of around 12 times, and it's still got very chunky dividend yields. So I think China could be up about 20, possibly even 30% between now and the end of the year. The Hang Seng index specifically.